And we talked about before, the size of what's happening with global M2 and the dollar moves and stuff like that are very big. So no reason to expect that the move in asset prices is probably more than people expect. And I think the inverse to the business cycle being so low for so long will be the flip side of this cycle will be longer than people expected, because we've got this slight dislocation still working through post-COVID that then extends the business cycle. We don't know yet, but it feels like it's Q2 2024 so far. But if financial conditions keep moving, if they really have done some sort of Mar-a-Lago accord and they get the dollar below 90, okay, then we're going on further. Maybe it's a full bubble cycle then. Maybe we don't get who knows? But, one step at a time, but looks good.
Raoul Pal begins with a macro framework that centers around one thing: liquidity. In his view, the massive global debt burden leaves governments with no choice. They must keep injecting liquidity into the system. Why? Because refinancing debt at high rates would collapse everything. The only option is to loosen financial conditions. By the way, if you're enjoying this breakdown, make sure to like the video, subscribe, and drop a comment below. It not only helps the channel grow, but also signals to the algorithm to share this content with more people like you. Let's continue. Pal highlights indicators like the ISM, the Institute for Supply Management Index, which remains at depressed levels. That mirrors what business owners and households are feeling: high mortgage payments, rising car costs, and stagnant wages. It's painful, but Pal calls this a setup phase. As the business cycle turns, Pal argues, disposable income increases, reinvestment returns, and capital flows back into risk assets, including altcoins. This isn't a matter of opinion. It's how liquidity cycles work. Capital climbs the risk curve as macro conditions improve. That's why Pal says the smart money is already positioning for what's next.
Just using the liquidity framework, the business cycle framework, the financial conditions framework, it's all suggesting that the probability is, because they need to roll the debt, they're going to have to increase more liquidity, and this is just going to drive assets up strongly. And again, just so people understand why the business cycle matters for the ISM, if you think the ISM has been low, and then go and ask the average American running an average business in an average town, how are you feeling? They say pretty shit, right? People's earnings haven't gone up. Your mortgages are too high, your car payments are too high, etc. So what happens is when the business cycle picks up, there's more disposable income and businesses have more investment income, and that gets driven out the risk curve always. That is what markets do. That is the game. And altcoins, as Julian said, are no different than junk bonds, no different to all the other stuff. It's all the same trade. So it feels like it's all to come for us. We don't see anything that suggests it's not going to happen. And we talked about before, the size of what's happening with global M2 and the dollar moves and stuff like that are very big. So no reason to expect that the move in asset prices is probably more than people expect. And I think the inverse to the business cycle being so low for so long will be the flip side of this cycle will be longer than people expected, because we've got this slight dislocation still working through post-COVID that then extends the business cycle. We don't know yet, but it feels like it's Q2 2024 so far. But if financial conditions keep moving, if they really have done some sort of Mar-a-Lago accord and they get the dollar below 90, okay, then we're going on further. Maybe it's a full bubble cycle then. Maybe we don't get who knows? But, one step at a time. But looks good. The big picture part is, look, from our work, we kind of noticed the business cycle structure. We're both business cycle analysts. We've both been looking at them for a long time. It changed after 2008, and it became like a metronome every 4 years. That's only happened once in the past, which was the 1950s and 60s, where it became very, very cyclical. But this is perfectly cyclical. And it got me thinking for a while, what the hell? So many of us didn't understand what happened to asset prices after 2008. We kind of knew quantitative easing was happening. We kind of knew stuff, but we didn't figure it out. And what I suddenly realized is that in 2008, we had a debt jubilee. And in fact, it was just forgiveness on interest. You don't pay interest payments. Remember, we did that over COVID. Exactly same mechanism, no interest payments. So no interest payments allowed every government who had basically, they'd all gone over 100% of GDP in debt. So all economic activity, all economic growth was used to paying of debts. So what they all did was basically restructure their debts between 3 and 5 years, creating an almost perfect 4-year cycle. And then when you look at the debts today, we're in that 4th year now where the final part, the larger part of the debt is due. And what we found is they start injecting liquidity over a period of 3 years, reaching maximum liquidity. That liquidity injection never really gets taken back. Some gets taken back in the bear market years when they're withdrawing liquidity, raising interest rates, trying to slow the economic cycle because of inflation or whatever. But over time, liquidity keeps rising. It's rising at a rate of about 8% a year. And that is, in fact, the debasement rate of fiat currency. And what happens is, and this is the bit that gets contentious with people and they hate it, if you divide an asset by the global liquidity, you get to see whether it's outperformed. The debasement.
People hate that chart.
Oh, they hate it. Yeah, it is the best chart in the world because it then tells you, okay, if I'm to allocate to the S&P 500, I'm basically breaking even versus debasement. So the S&P 500 is not really adding much value. Well, when you look at the Euro stocks and other markets, which are priced in their local currencies, you put them in dollars, they look similar. They all the markets look very similar once you adjust for debasement. So that was interesting to me. Gold, complete almost flat line, really, versus debasement.
To drive the point home, Raoul Pal drops a staggering stat. When you divide the NASDAQ by Bitcoin, you get a 99.97% decline since Bitcoin's inception. Let that sink in. The best performing traditional asset class tech stocks has been crushed. When measured in Bitcoin terms, this isn't just outperformance, it's a generational paradigm shift. So if liquidity is the core driver of global markets and Bitcoin is the purest expression of that liquidity, then the investment case becomes almost unavoidable. Own crypto.
And once we look to the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only 2 assets that outperform this. One is tech stocks and the other is crypto. And so that completely changed how I allocated and how I understood tech stocks. I was a macro guy. I hated tech stocks. They're always too expensive. You're always a value guy. And I realized none of that made sense in this market. That's why the value investors have been getting killed, is what had happened was all of this. Now, what is driving this? And I think, Julian, if you can just bring up those demographic charts, because these are the absolute most important charts in the world, really to understand. GDP growth is driven by this magic formula, which is debt growth plus population growth plus productivity growth. That's how you drive trend rate of GDP. Now, debt growth's gone to extremists, and now really we're just servicing debts. Basically, GDP keeps falling, and it's falling over time, the trend rate of GDP, because of the magic formula. And Julian, if you can get to the demographics charts, because they're the key ones here. The issue is here, the biggest secular factor in all of markets is this one thing, is the aging of population. And we can see the births rate is falling in the US much faster elsewhere. So that obviously is a function, the labor force participation rate, the size of the workforce, is a function of births, deaths, or the number of people being born, whatever, right? And you hear the phrase demographics are destiny. They are. Until the AI and the robots come, which are basically artificial humans, this is the problem that faces us all. But there's a way that they've got around this. If you go to the next chart, is they've increased government debt to offset the declining growth from the population. So part of the magic formula was the debt growth and the other was the population growth. So they've used debt growth. This chart, nobody understands, and it's never been copied on X, which is the bizarrest thing because it's the most incredible chart of all, which basically says that all government debt growth is basically a function of labor force participation rate. Now, what's interesting is then, okay, so the debts keep going up. We know the forward look of where the labour force participation rate is going to go, and how it's being funded is liquidity. This is Fed net liquidity. You're probably better to use US total liquidity because that includes the private sector, because they're now using the banking sector. So what they're doing basically is debasing currency to pay for the debt. It's as old as the hills. It's as old as the story of economies. It's as old as the story of money. And it's happening at a very pernicious rate of 8%. So you kind of notice it, but don't notice it. But what's happening is asset prices keep going up optically because the currency is getting debased. Even if you look at real estate adjusted by the debasement, by liquidity, it's basically a flat line. But wages are a variable input. And so what you find is that wages do not account for this. It's also the same factor that is driving PE ratios that drives everybody nuts. Why are PE ratios going up over time? Because the P goes up because of debasement. The E is a variable and doesn't. So it always goes up in line with debasement. And we've shown that over time too. So this is the really big picture of what we look at. It allowed us to understand there's only two assets to own. And then we got to a further realization, which is, okay, if 97% of all of NASDAQ's price action is driven by debasement. It's the strongest factor we've ever had in any macro regime in history. Okay, great. That makes macro super easy. For crypto, it's 90%. So we've basically got a factor that's so powerful that nothing else matters. Brilliant. So then let's take the NASDAQ. If we've got one force, one economic force, we take the NASDAQ, we divide it by by Bitcoin, it's down 99.97%. So you kind of get one asset allocation only, which is crypto, which is bizarre. In a macro world, we now think you need concentrated portfolios as opposed to diverse portfolios. In fact, diversification just destroys returns now because you've got one clear macro factor. So that's really what we're doing. And then we spend a huge amount of time working on the business cycle and the various components of all of this, how it comes together and where we are in timing of that.
To wrap up, Raoul Pal presents a macro framework that rewrites the rulebook. Liquidity isn't just important, it's king, the dominant force behind asset prices. Business cycles have become almost mechanical, shaped by massive government debt and the need for constant refinancing. Fiat currencies, they're being debased quietly, at a steady clip of nearly 8% a year. Only crypto and tech stocks have consistently outrun this stealth inflation, and now, demographics are creating slow-moving economic pressures. While AI is accelerating change at the edge of everything, the big takeaway, most investors are still playing by the old rules: diversification, value stocks, inflation hedges. But in this new regime, those strategies are obsolete. The winners? They'll be the ones who see the liquidity wave early and ride it all the way to the top. Thanks for watching. See you on next one.